Uh, Good morning, everyone, and uh, thanks for joining on today's webinar. So today we will discuss mostly what's the current market construct, and also most of the market participants might have been having question about where does the current valuation stands with respect to various market segments. So, and one of the major questions that has been coming up is that how should one look at the large cap as a investment potential as of with respect to the current market construct. So that's where we thought of having a topic where how should one look at doing a lump sum in large caps with the current market construct. So today we'll have just three major sections. First, we will just cover what's the current macroeconomic picture that we have in the domestic market, and then second, we will look at the earnings. How has been the current ongoing quarterly second quarter earnings, and then what's the expectation of the earnings for the next 2 3 years. Then on the last section, we'll look at the valuations. So valuations, we will compare the large cap versus mid and small, and then we will end the webinar with Q&A. So moving to the first section on the macro side. Uh, so as a house, we have been pondering over this, and so since COVID, how has our economy performed, and what has been the momentum versus strength? So there are two key factors. One is that economy momentum. So momentum in terms of quarter over quarter and month over month growth in high frequency indicators. That's these high frequency indicators will provide us a view of how the economy is trending towards. And on the other side, economy strength. So economy strength in terms of so how is the banking sector positioned in terms of lending, and and economy strength also involves in terms of what's our forex position, what is our current account deficit. So putting together this economy momentum and economy strength indicators, we have just categorized how our economy has performed in the last 5 years. So during the COVID years, right, 2020, 2021, so our economy momentum got tremendously curtailed because most of the businesses have been working in a limited scope because of government restrictions. So economy momentum was very low in the initial years, COVID first wave and second wave. Well, on the other hand, economy strength was medium. So our government didn't go for major fiscal based benefits to the people. So they had a balanced view on the fiscal based benefits that goes into the people's hands. So in that way, they were able to maintain the overall economic strength in a medium way. So this is where the economy was there in the 2020, 2021. Then moving to the next couple of years, so what happened was that post the second wave and things like that, and so our economic momentum really took place in the last 2 years, 2023 and 2024. This is in the financial year. So where we saw that all the indicators, right from the monthly GST collection to the e-way bills, so all those high frequency indicators uh, were growing quarter over quarter on a year-over-year basis, and because economy opened up, and we saw that especially from the premium segment of the consumption side uh, was growing faster, and even towards the end of FY24, we saw that even the mid-level mass segment also starting to come back, and economy strength moved from medium to high. Because if you look at globally, what happened was that during the COVID, most of the developed countries were handing out cash directly to the people, and they are building the fiscal deficit at a higher rate. But Indian government, I think they took a being a developing country, and so they took a balanced view in terms of how should they give out the benefits to the people. So they took care of the majority of the people in terms of mass segment, in terms of having increasing the rations to the people. So in that way, they took a balanced view, and then that way, from a medium level of economic strength, as momentum gathered, so we moved just within a year to a strong economic strength. So what happened was that with good momentum and with economic strength, this has reflected in the earnings cycle of the companies. So you might have noticed that across the market, there was a broad-based earnings recovery, and the recovery was much more faster in the small and mid cap, because usually the small and mid caps earnings tend to outperform large caps when the economy is gathering more strength and momentum. So in that way, we saw that the earnings growth of the small and mid cap was higher than the large caps during these 2 years. So going forward, what's our expectation is that we will see some amount of, I could say that normalization in the momentum, because one thing is that the base effect comes into effect. So we have a quite a high base or a normalized base. So from this normalized base, uh, the economy has to grow at a long-term average rate of real GDP of around 6-7% kind of thing. So the 2 years of high growth period we are coming out. So we are entering a normalized kind of economy momentum in terms of, and we expect economy strength to continue, because that's reflecting in the banking sector or the exports. Even though uh, globally the demand momentum is slowing down because of geopolitical issues, but India continues to gain market share. So in that way, at least either on the current account deficit or a forex position and export, I think we are still uh, at a stable level. So that's broadly with respect to where we stand from the macro perspective. So, uh, so the key takeaway is that we are entering a zone where we can expect a normalized growth levels, where the momentum is getting normalized. So in that economic constraint, right? Uh, so why do we find large caps as a edge over the mid and small caps? So when the economy is trending towards slightly a downward growth or a normalized growth, typically in the last cycles, what you have seen that large caps tend to do a bit more better than the small caps in terms of earnings. So that's because large caps are usually have a stable and proven business model. They will be usually the market leaders in their own business, and that will enable them to have a much better growth. And also, in terms of balance sheet, in terms of cash flow, they are much more better positioned than the small and mid cap companies. So as we are entering a downward or a slightly muted kind of momentum in terms of macro, large caps with a proven and a stable business model, I think they will be able to post a better earnings growth going forward than the small and mid caps. So that's broadly the first section in terms of where do we stand with respect to economy, and where do we stand with respect to uh, in terms of large caps performing over the small caps in terms of earnings growth. Moving to the next section in terms of earnings, right? Uh, so uh, the second quarter of FY25 earnings is currently ongoing. Initial trends are almost, I think, more than among the BSE 500, I think I expect close to more than 200, 250 companies would have declared the results so far. And within Nifty, I think almost more than 35,000 companies have declared the results. So these are the key trends that we found in the ongoing result season. So one thing is from the consumption side, it's very clear that urban demand especially on the discretionary side, has been slowing down. So this has been uh, put out by companies like Nestle or HUL. So both of them have clearly highlighted that there has been a strong decline in the urban demand. While on the rural side, their rural is coming out of a low base and coupled with good monsoon this time, and so the Kharif harvest has been performing good. So rural is in a stable wicket, I would say. So rural is seeing a gradual recovery. While on the urban side, there has been a decline because major reasons highlighted is that steep food inflation. So the food inflation, especially we are seeing that the kind of inflation that we see in vegetables, whether it be a tomato or a onion. So this has impacted the urban mass consumption. That's broadly from the consumption side. And even if you go to the next on the financials, even financials, this has been reflecting because within the banking segments, we can see that microfinance has been one pain point area for across all the banks and NBFCs. And we have seen that in Q2 so far, the banks which had higher exposure to the microfinance had taken higher provisions, and we have seen that their non-performing assets on the MFIs has gone up in the last quarter. So the first on the weak consumption is reflecting on the like on the banking side, especially on the microfinance side. That usually the total loan amount would be in the range of 30 to 40,000, and it's being lent to the bottom of the pyramid people in terms of income. On the other major sectors, for example, IT, I think the in terms of growth, also in terms of commentary from the management is mixed. So IT services will be growing at around 5 to 6% kind of growth trajectory. That's what the trends see. And on the capital goods and other infrastructure-based companies, due to elections, we had the central elections and then a couple of state elections. So all this thing has resulted in government capex coming down on a overall, if you compare year-over-year basis. So with slowdown in government capex, I think most of these infra and capital good companies have seen some amount of moderation in their growth levels. And that's again on the manufacturing side, exports. So with globally a couple of geopolitical issues going on, and even globally, I think the key election in US. So that has resulted in again moderation in exports, and even we saw that even on the automobile exports, passenger vehicle has done quite a bit well. But on the other hand, if you look at other exports in terms of tires or other component exports, I think there has been some moderation. So that's broadly the key takeaways from the Q2 results so far. And if you look at the numbers, right? This is as of 5th November. So what are the companies that have declared the Q2 results? So we have seen that you see within Nifty, out of 33 companies, overall earnings growth has been like flat for the quarter. On the other hand, if you look at the BSE 500, that's much more broader index that shows that the earnings has declined overall by around -6%. So this has to be looked in the constraint that what we saw in the section one, how the economy is moderating, and so as expected, the earnings growth of large cap companies are expected to be a little better than the broader mid and small cap indices. And within in terms of sectors, we're not going in deep, so it's we broadly look at the large and mid and small as segments. So, getting into the forecast, right? Next 2 3 years, what's the expectation that the market is building in, and uh, over the for the earnings? So, if you look at last 5 years, right? Last 5 years, Nifty. Nifty 50 EPS CAGR has been 16%. On the other hand, if you see the Nifty small cap under the earnings growth has been 26%. So this is what we have been saying that when the economy momentum gathered, I think that pushed up, that gave a huge tailwind for the small cap companies, and they had a better growth versus the large caps. So that's where the almost 10 percentage point outperformance of small caps versus Nifty the last 5 years in terms of earnings growth. Well, next 3 years. So one reason would be that economic momentum moderating plus base coming into effect. The broader expectation over the next 3 years is that Nifty small cap from here, I think the earnings growth will moderate from 26% 5-year CAGR in the last 5 years to 14%. On the other hand, even large caps, you're expecting a 12% kind of earnings growth. So the delta of outperformance of small caps versus Nifty 50 will narrow down from 10 percentage point to almost 2 percentage points. So this has to be factored in the valuations also. So when a segment of a market is growing abnormally higher, so normally it tends to get a better valuation. But as we go into a zone where the outperformance is going to come down, then actually the valuations also has to be looked at from this kind of scenario, and then we have to moderate the valuations for the small and mid caps. So with this constraint, we will move to the third section in terms of valuation. So sorry, before that, we look at the ROE also. So we will look at the earnings growth. That's one point, and even the second point on ROE. So I'll just touch base on ROE because so valuations it has two major variables. One is that how is the growth, and second is the profitability. Here, so as far as the Nifty is concerned, I think in terms of trailing or forward, I think the ROE tends to be stable at around average is around 14%. So at times it tends to go to around 16% where we are in the better best macro situation. So profitability of the large cap companies tend to be have a lower volatility. So that's where I think they're able to post a average ROE of around close to 14%. So moving to the last section on in terms of valuation, first we look at the performance. So last, if you've taken 1 year, 3 year, or 5 year, so we have seen a broad-based, huge outperformance by small and mid versus the large caps. So we can see that 5-year basis, Nifty has given 103% kind of return, while the small caps has almost given outperformed with double that of that, close to around 200% return. So the performance has been broadly good. So we can't just extrapolate the kind of return that we got in last 5 years in next 5 years. So when you are what are the key drivers that has to be looked when projecting the next 3-5 years earnings cycle? One could be the, as we saw on the macro side. Another could be the overall the base that has already formed into the businesses. So in that construct, you have to look at the multiples. So if you can see here, like this. Yeah. So the stock price as a performance depends upon two major variables. One is the earnings growth, another one is the multiple change. So if the earnings growth of the small cap companies over the last 5 years has been upwards of 25%, but the return has been close to around like the CAGR has been much higher than the earnings growth. So the extra return has been factored by the multiple change. So here you can see that small caps, which before COVID used to trade at around 14 times on a 1 year forward, now they are trading close to 26 times on a 1 year forward. So there has been a close to around 78% re-rating that has happened. Even on the mid cap, you can see that the re-rating has been around substantial, close to similar to small cap, around 70%. So uh, you have to segregate the last 5 years return of small and mid cap versus how much was the contribution from the earnings growth, how much was result of the re-rating of the companies. So earnings growth is a much more fundamental factor for the long term. Usually, what we are seeing is that the stock prices and the earnings growth will match. So the re-rating happens usually because of the bear and bull markets. So as the sentiments goes up and down, that's why the re-rating and things goes happen. But over the long term, uh, the stock returns will converge along with the earnings growth. On the other hand, we have seen that even on a Nifty 50 also, large caps there has been a re-rating, but it's just half of what the re-rating has seen in the mid and small caps. Yeah. So moving to the next slide. So with this construct, with the expected earnings growth and then the current valuations where the market segments are trading, um, if you look at Nifty 50, 1 year forward is close to around 22 times, which is in line with the last 5 years average. And but if you look at the mid cap and small cap, so both are trading at a substantial premium to their last 5 years average. So if you look at small cap, last 5 year average is 19, they're trading at close to 26 times. Mid cap is substantially higher. So last 5 years average is 23 times on a 1 year forward PE. They're now trading close to 36 times. So it doesn't mean that trading at a premium to the last 5 years is wrong. So if the next 3 years the earnings growth is going to be higher than the last 5 years, then the market or a company is trading at higher P is valid. But as we are expecting earnings growth to moderate, then this looks like a opposite kind of counterintuitive because uh, current valuations are at a premium, but we are expecting earnings growth to moderate. So that's where the broadly the market construct is as of now. And so as we have seen that in the current second quarter result season, there has been a broad-based moderation in earnings. Even on a Nifty, usually the as of Q1, the projected Nifty EPS was close to around for FY25, it was close to around 1,080 rupees, but they've downward revised to around 990. But even on a downward revised BPS, I think Nifty is trading at last par with last 5 years average of close to 22 times. And so we have seen the earnings growth, we have seen the price to earnings multiple, but one more key metric that we usually track is that equity risk premium. So equity risk premium is a much better indicator of where the market is, whether it's overvalued or whether it's undervalued, because it captures the market participants' sentiment. Because in that way, because when the risk premium is very low, right? So market participants are very aggressive in terms of buying companies at any valuation, because they're okay with going with a lower return. So what risk premium usually captures is that the excess return that the equity offers over the other risk-free instruments. So suppose if the risk-free rate currently in India is close to around 6.5 to 7%, if the equity risk premium is 4 or 5%, then the monthly what's the return expectation from the equity is that 11%. So the extra 4-5% that the investor gets by being in the equity is what given out by this metric. So whenever the investor feels that uh, is very more aggressive, very more bullish, and ready to buy companies at high valuation, then obviously the risk premium shrinks. So that shows that the market is overvalued. So here, if you see that for the Nifty over the last 20 years, right? So here you can clearly see that whenever the market is overvalued, our risk premium is close to around 3.5. So that's the when we have to be very cautious in terms of overall market. And in the market crashes, right, like in 2008 or 2020, our the equity risk premium, as instead of year 2008, it was close to crossed 8%. 2020 crash, it was crossed around 7%. So these are the like much more undervalued kind of positions. So, what's the current uh, equity risk premium is close to around 3.9 times. So, so if you see in the last at least 3-4 years, whenever the equity risk premium dropped to 3 or 3.5, that's where the market became more value. So now it's back to around 4% post 6-7% correction in October. So now it's back to close to 4%. Uh, So it shows that there has been some amount of moderation in the market in terms of returns. So that's where we are in terms of valuation. So P is one kind of relative valuation metric, while ERP gives out another interesting metric to track the overall valuation. And then we have seen individually what's the kind of valuation, but here we will just compare the Nifty versus the mid cap index. So here you can see that. Where the two indices are trading. So there has been a substantial premium in which midcap is trading over. So other charts, yeah. So these are in terms of premium close to around 50% of premium. So usually in terms of whenever uh, there is a strong bull market, midcaps tends to outperform the Nifty index, and its premium over the Nifty tends to go up. So just on the last slide. So this is just a rebase to 100 over the last 10 years. So so small cap, mid cap, if you look at the last cycle during the 2017-18, so when they outperformed the large cap indices, when there was a strong small cap bull market. And then post that, we have seen that even the current outperformance has been much more larger than the previous cycle. So that's where we are in terms of valuation. This clearly shows that we should be very cautious in terms of approaching mid and small caps. So that's broadly, we have covered the macro construct and then the earnings expectation and the valuations. This is on the risk side. So in case of any broader market drawdown or we have seen that historically large caps tend to outperform the small caps. So basically what this means is that we tend to lose lower than the being in the large caps than in the small caps when there is a uh, broadly a downturn which is expected. This has been across cycles. So here you can see that in 2008, 2009, the bear market, larger Nifty index, which fell close to 50%, while the small cap 250 fell close to 70%. So these were whenever the valuations are high, and there has been a last 3-4 years, the outperformance of the mid and small has been quite phenomenal. So we have to take a cautious approach and then construct the portfolio which is more and more inclined towards large caps, whereby we will be positioned in a much more safer way. And so with this broad construct, what should an investor expect from the current market, right? So this is one chart which across the house we track it. So this we call it as a Nifty vantage point. So this gives us a view of Nifty returns at various points on if an investor has entered. So broadly, if you study this chart, right, it shows that at any point an investor entered if he is stayed longer, I think his return expectation has been around 12-13%. So that's broadly. So even now, I think with the expectation what we have gone through over the this session, I think that's broadly an investor should expect from the overall market. So what are the return expectations that we had in the last 3-4 years is uh, was phenomenal. It was over and above the earnings growth, and because there is a lot of re-rating happened, things like that. So we have to temper down the overall our market return expectation and prepare a portfolio that would withstand the upcoming macro uncertainties and the valuation part. That's so on one hand, the earnings growth will moderate. On the other hand, we are very clear that the valuations in mid and small continues to be quite high. So with that construct, overall the return expectation has to be clear from an investor's perspective. So that's broadly from my side in terms of where does the market currently stands and why large caps are currently a little bit better position compared to the mid and small. So yeah, uh, thanks. And if you have any questions, just you can just unmute and then ask, or you can post it in the chat box. You can raise your hand if you have any questions, or you can also post in the chat box. So we have one question. Vishnu, is the valuation now cheaper, right? Valuation, uh, you're, that's what we've been highlighting that we have to segregate the market across various segments, large, mid, and small. And we clearly see that valuation is quite high in the mid and small, while valuation is reasonable in the large caps. Uh, yeah. So from Naveen, is it the right time to lump sum now or continue to do shift and increase when the market is down in large caps? So yes, so in terms of large caps, it's the right time to do both lump sum and SIP. You can continue the SIP and also on the lump sum basis because there is a reasonable valuation continue to be reasonable and the earnings growth expectation is also in the close to around long-term average of around 12%. So yes, I think we currently as a house prefer large caps both for lump sum and SIP. And, another question from Vishnu is that which P is high valuation in large caps? So if you take a large cap and then segregate across sectors, so usually the valuation differs across sectors. So take FMCG, they historically last 10-15 years, they used to trade at around upwards of 40 to 50 terms in terms of PE. Within sectors, the valuation multiple differs because the entire business model differs and things like that. So one has to look at the entire large cap segment as a valuation. So that gives us a better metric if you're using large cap indices. So next question from Kannan is that what about existing SIP in small cap? Do they just stop and put in larger? Kannan, I think this depends upon individual basis because in terms of what's your current age, where do you stand with respect to your life cycle, right? because that's where the individual advisors will be giving you the clear picture. Because what um, instead of stopping a SIP and then moving to large cap, I think individual basis, because in what age profile the current individual investor is that, and then the that will decide majorly in terms of switching over from a one product to another product. So the main idea of this webinar is that to provide a perspective of large caps and why large caps as a little bit edge over the small caps in lump sum. So I would request you to speak with the individual your relationship manager and then take a call on this. Another question from Gopinath. In large companies, in comparing the companies within the sector, is it okay to look at the historical P or a company which has a lower P which is based? Uh, uh, so P is one metric which is a relative valuation. So even when you're comparing a company with its historical PE, in case a company is going to post a better earnings growth as its historical average, then obviously we have to give a premium to the same company because it is going to put out a better performance. Uh, so when you're comparing with the companies to company within a sector also, what you have to compare is the first thing is that the earnings growth. Uh, how the two companies are going to grow over the next at least 3 years, if you can get a visibility. And second is on their cash flow. So a company which can, suppose if we take two companies which grow earnings at a similar rate, but if one company is able to generate free cash flow that is much higher than the another company, then obviously the better free cash flow generating company will get a higher PE. That's because uh, that will enable the company to invest more internally. You don't need to source debt for growth. So in that way, when you're comparing the companies, just take up and have a 2 3 years forward-looking earnings growth, cash flow generation, that is free cash flow generation, and then the ROE. So these 3 4 metrics, if the company A is better than company B, then obviously company A will trade at a much better P than B. So that's how we have to broadly look at the valuations among the companies within the sector also. Another question from Venkatesh is it good for elder senior person to invest lumps in large cap? Uh, yeah. So again, uh, it depends upon the overall your asset allocation, right? So because since if you have a discussion with your relationship manager, then you can provide the entire your asset allocation as of now. Then within the equity, then the relationship manager will have a fall over what to put a lump sum in large caps. So you can also raise your hand if you want to ask. Just unmute if anyone has questions. Yeah. Thank you, Raja. Thank you. Okay, if you have known as any questions, you can complete the webinar. And once again, I think thank you everyone for joining. Hope I think you have gained some perception in terms of what is the various market segments have been trading now. And personalized questions, you can post it to the relationship manager, and then you can take a call. Yeah. Thank you. Thank you, everyone.